Thank you very much, all of you, for coming today. A month ago, when I entered the Oval Office with my wife and my two sons to present my credentials to President Obama, he was kind enough to tell my children, who of course never believe what their father tells them, I've been working very well with your father in the G20. We've done a few things together. It was, of course, extremely nice of a president to say that in front of family. I was extremely proud in front of my children, who looked at me like, well, after all, maybe you were doing interesting things all these years, and important ones. So it was a good moment. It was a very good moment of my first days here in Washington, and I wanted to share them with you, as Fred reminded all of us of my participation in the G20. And I will bear that in mind as I speak today and as we interact later on, because I think a lot of the issues we will have to discuss today have a lot to do with the G20. And I may tell you what I feel about the G20 today and what it could be in the future. But before all that, let me start by saying thank you, Fred, for your kind invitation and for your very nice introduction. It's a pleasure to be here today at the Peterson Institute. I don't think I could find a better place to talk about the kind of issues I would like to raise today. I'll be talking about the way Europe responded to the financial and the economic crisis, the way with which we dealt recently with our single currency project. And in saying so, when talking about this, I will here and there make use of Mark Twain's interesting quotes. But before talking about this, a word about Fred, who unites us all here today. As he himself is normally quick to point out, he was a Euro enthusiast when the vast majority of US economists, I dare say, were rather skeptical about the Euro. Fred was prepared to go against the grain and predict that the Euro would bring significant benefits to its participating countries. When the Euro was celebrating its 5th anniversary, Fred took the opportunity to call it a spectacular success, while also pointing presciently to the unfinished business of economic and monetary union and to the need to further reforms to capitalize on its potential. Fred was right, even if others were slow to acknowledge that fact. As you may know, I'm not an economist by profession, but rather a history graduate. So it was with great curiosity that I read a recent piece by Mr. Rashman in a Financial Times, comparing economists and historians. Economists, he implied, have a tendency to be wedded to their paradigms. Historians, on the other hand, have often been seen as entertainers and storytellers. As I address you today, a largely economist-based audience, I believe, I hope to be able to help all of us reflect upon your own paradigms. And in doing so, I hope to entertain you and tell you a good story about Europe and about the Euro. One paradigm that many economists are fond of, as we all know, is that the Euro area does not constitute an optimal currency area. And this would explain a great deal of the Euroscepticism or even Euro-pessimism that you hear in the debate. I believe this way of looking at the Euro, which is respectable, misses one essential point. And the point is that the Euro was also born out of a political idea, a political commitment by European countries to deepen, to strengthen the ties that bind them together. We have, in Europe, learned painful lessons from our own history about what happens when countries blindly pursue their own narrowly defined self-interest. The creation of the European Union and the creation of the euro area are, above all, symbols of Europe's capacity and willingness to take far-reaching decisions to define a common future for a continent that all too often has been riven by warfare and political instability. Even if, at inception, the model is not perfect or optimal, even when most deem it impossible to achieve, even in those circumstances, Europe has proven to be able to move forward. And this reminds me of Mark Twain and brings me to the first quote I would like to borrow from him today. He said, "We did not know it was impossible, so we did it." Well, the case of the euro is slightly different, but I think the quote is still usable in this context. The euro was indeed seen as impossible before it was created, and not just on this side of the Atlantic. It was not only economically impossible or technically impossible. For many people, it was politically impossible. But even with all these doubts, economic doubts, technical doubts, political doubts, Europeans did it. And we don't regret it. As a good historian, of course, I need first to go back before I come to the present realities, if you don't mind me doing so. And I would like to look at what I would call a decade of achievement for the euro. But these achievements were always accompanied, here in the US, back in Europe, by sort of permanent doubts. We heard a number of things. It's a bad idea, we heard. It can't happen. It is flawed. And I must say we heard it particularly in the English language. For example, many question whether countries like France, Belgium, Italy, with a history of less than perfect management of public finances and relatively high inflation, could comfortably survive in a currency union with Germany, which had a more stability-oriented culture. Today, what we see is that these countries have graduated to what is called the euro area core. Belgium, for example, used the discipline of euro area membership in a positive way, significantly reducing its debt ratio in the first decade of the EMU. Similarly, when euro notes and coins were introduced back in 2002, many predicted a logistical nightmare and even political upheavals as the national legacy currencies were replaced. But in the end, the process went extremely smoothly, given the circumstances, and people quickly took to using euros in place of their Deutschmarks, francs, and liras, thanks to a very good public education program, I would say, but mainly because Europeans believed in the project. Mainly because there was sympathy, there was support, not only in political elites, which is absolutely necessary and was necessary at the time, but also among the population. It was not easy, as you can imagine, for Germans to give up the Deutschmark. It was not easy for French to give up le franc français, be it old or new or whatever. It was not easy for Portuguese to give up the escudo, if I may add a particular personal remark. But we did it, and overall, with a great success. But when the euro depreciated, and its exchange rate went down after its launch, people were saying, but is this really a serious currency? Is this a joke currency, or is this something that can, you know, stand up to the dollar and other currencies? Well, the doomsayers were at work again. But once again, their doubts seem to have proved misplaced, as the euro quickly became one of the two main international currencies alongside with the US dollar, and with a share of foreign exchange reserves that would exceed that of the currencies it replaced. But most importantly, when we talk about the achievements of the euro in its first decade, the one I'm referring to, but I think it applies beyond that, of course. Most importantly, the euro helped to lay the foundations for macroeconomic stability in Europe, which is essential for creating jobs and prosperity in the long term. On inflation, it had hovered over 9% in the 70s and over 7% in the 80s. It was brought down to around 2% in the decade since the euro's birth, in line with the ECB's definition of price stability. The euro also boosted trade and investment between its member countries, thus helping the European single market, the other big idea, to function more smoothly and efficiently. And it contributed directly and indirectly to the massive growth in employment that the euro area countries experienced over the first decade. We created 16 million jobs in the euro area. It's the fact that it's not always well known elsewhere, and here Mark Twain has a nice expression: lies can travel halfway across the world while the truth is putting on its shoes. But there is, in every silver lining, there is a cloud. And after a decade of achievements, the probability of a crisis happening grew. One of the most famous American economists, Milton Friedman, had warned that the euro would not survive its first crisis. So all of us, all of you, and all of us in Europe were anxiously waiting to see how the euro would deal with its first real crisis. And we certainly have had a real crisis, a deep and profound crisis in the world economy, in the European economy, in the American economy, unprecedented in our generation. In the euro area, GDP shrank by 4% in 2009, the sharpest contraction in post-war history, and over 6.3 million people lost their jobs. But the crisis also saw European leaders demonstrate leadership, capacity to work together decisively. In December 2008, we agreed the European Economic Recovery Plan, coordinated fiscal stimulus amounting overall to approximately 5% of GDP in 2009 and 2010. Each country had to implement its own fiscal stimulus in accordance with its own capacity, of course. But this was truly a demonstration that countries with independent fiscal policies could act quickly and decisively together if they were bound by a common purpose, but also by a common challenge. The European Central Bank cut its benchmark rate to a historical low of 1% and adopted a series of unconventional measures to inject liquidity into the financial system and get credit flowing again. European countries also undertook significant interventions to stabilize their financial sectors. Together, the EU countries injected nearly 300 billion euro worth of capital into financial institutions and extended 2.5 trillion euro worth of guarantees. These policies largely succeeded in achieving their objectives. The economic contraction, though large, was stemmed, and the number of job losses was contained relative to what could have happened had they not been enacted. And it is worth pausing to remember what would have happened without the euro, because, you know, one always has to look at the alternatives. And I believe, as I hope you do as well, that things would have been a lot worse if we had not had the euro and the euro area. Exchange rate turbulence between the countries that are now part of the euro area would have been highly disruptive to trade and investment flows, making it likely that the economic contraction would have been far deeper and the destruction of jobs far more severe. And it would also have been a lot harder for 16 different central banks at that time to coordinate their crisis response to achieve the same outcome as the ECB attained. So the initial crisis response seems to have been highly effective and went beyond what many commentators, politicians, would have thought possible. But by itself, it was not enough. The crisis exposed, like all crises, I believe, exposed several weaknesses that were not unknown, or not enough known, or not enough taken in consideration, and were definitely not well addressed in the first decade of the euro. So what were the main weaknesses we could identify? The first one is that the governance of the euro area was found wanting. The rules of the Euro Club, in particular the Stability and Growth Pact, did not operate as strongly as they should have. And some countries built up excessive deficits and debt levels. Good times did not see enough efforts at fiscal consolidation on the part of many governments. Second, the impact of the crisis revealed a much weaker underlying fiscal position in many countries, as tax revenues had been boosted by booms in housing, construction, and financial services. This story may not be unfamiliar to you here in the United States. And as revenues collapsed and growth slowed, public debt rose dramatically. Lastly, in this quick outline of weaknesses, the first decade of the euro was marked by persistent competitiveness divergences across its members. Wage and price trends in many countries were out of line with what economic developments would have justified. As I said, the policy response of the euro area to the global financial crisis met with considerable success. But the crisis was not over. It was bound to assume new dimensions. And markets would increasingly turn their attention to various countries in Europe, although they didn't always seem to be sure which ones they wanted to focus on. And this, of course, poses particular challenges to policymakers and authorities. And most of the time, as Mark Twain reminds us, the calamity that comes is never the one that we had prepared ourselves for. In 2008 and early 2009, the focus was on the emerging economies in Central and Eastern Europe, the CEE countries, and not directly on the euro area. But euro area banks had invested heavily in the CEE region and were expected to suffer significant losses as local property and construction booms collapsed. How serious a problem was this to be considered at the time? In February 2009, the front page of The Economist called it the bill that could break up Europe. But once again, I'm glad to acknowledge that the euro pessimism proved unfounded. Instead, through their commitments under the European Banking Coordination Initiative, also known as the Vienna Initiative, parent banks maintained their overall exposures in crisis-hit countries and recapitalized their subsidiaries as needed. At the same time, markets were focusing also their attention on particularly non-euro area countries of the European Union. Then we had Hungary, Latvia, Romania, were each forced to turn to the EU and the IMF to help them to cope with their reduced access to global capital markets. In each of these cases, the European Commission and the IMF worked closely together to develop financial assistance programs. Many argued that Latvia would be unable to simultaneously maintain its exchange rate pegged to the euro, undertake drastic expenditure cuts, and emerge from recession within a reasonable time frame. The Latvian government, on the other hand, argued strongly, with Brussels backing, that the exchange rate peg was an important anchor for their economy, especially in view of their ultimate objective of euro adoption, and that abandoning it and devaluing their currency would impose heavy losses on Latvian businesses and consumers who had borrowed heavily in euros during the good times. In the end, Latvia did experience a deep and protracted recession, with GDP contracting by 18% in 2009. Extremely hard measures were imposed on Latvian population. But the latest data show that the Latvian economy is catching up. Which brings me to 2010 and the Greek crisis. Greece's situation was born out of its own particular circumstances. Greece's debt and deficit had risen to very high levels in the years immediately prior to the crisis, and its problems were exacerbated by a steady erosion of competitiveness. In a period of extreme risk aversion, the interest rate that markets were charging the Greek government shot up to record levels. The government was forced to turn to its euro partners and the IMF for help. In May, Greece's euro area partners and the IMF jointly agreed to make available 110 billion euros in financing over the next 3 years, 80 billion of which provided by the euro area. The IMF is providing 30 billion. I am aware that here in the US, some members of Congress have objected to the idea that American taxpayers' resources are being used to provide financial support to a European economy. But I want to make it absolutely clear that this is by no means a bailout of Greece, as some have called it. Firstly, the money is being lent to Greece, and the Greek government is obliged to pay it back. Secondly, in order to qualify for the loans, the Greek government has had to sign up to very tough conditions. It has had to commit itself to a wide-ranging reform program designed to put its public finances on a sustainable path and improve the economy's growth potential. The aim of the program is to restore Greece's ability to once again borrow from financial markets. Thirdly, the Greek government's reform program has made a strong start and is on track. The government has made impressive progress on both the fiscal and structural fronts, including by implementing a landmark pension reform. And as you may know, may have seen, and may of course imagine, this was extremely painful for the Greek public opinion and population. But these measures will help Greece to achieve higher sustainable growth over the medium term. I want to emphasize the strong political commitment of the Greek government to carry through these reforms and the strong support which they are receiving in this respect from their European partners. Finally, I want to point out that by helping Greece in this way, the IMF is fulfilling its mission of supporting global financial stability. And as for the US interest, I remind you of the strong ties that bind Europe and America together, and of the substantial number of jobs in this country that are supported by inward investment by European companies. This should help to illustrate why it is in America's best interest to help the government of Greece. As Treasury Secretary Geithner noted earlier this year in his congressional testimony, Greece is a member of the IMF and has a right to borrow from the IMF if it is willing to commit itself to tough measures that will enable it to repay what it has borrowed. By the spring of 2010, strains had emerged in other European sovereign debt markets, notably those of Ireland, Portugal, and Spain. The fiscal positions of these countries, each of them reflecting their own circumstances, meant they were now vulnerable in this far more hostile market environment. It was by then clear that we had to send a very strong signal that we would do whatever it would take to defend the euro. But it was increasingly clear that our existing instruments for dealing with the crisis would not be enough. We would have to create new ones. But it is no easy feat for a government to match the frenetic pace of the financial markets. It is even more difficult for 27 governments to do so. From November 2009, when we learned about the revisions to Greek budgetary statistics, to mid-May 2010, when we unveiled a comprehensive package to restore financial stability and avert contagion from the Greek crisis, the governments of the EU were running both a marathon and a sprint at the same time. A sprint in the sense that financial market developments moved rapidly, occasionally catching us out of breath, but also a marathon in the sense that the distance, the political distance to cover, was great. I'm happy to realize that on both races, we crossed the finish line and alive. The new instruments we created were substantial in both scope and scale. The European Financial Stability Mechanism and Facility together provide financial support of up to 500 billion euros for countries facing difficulties. These measures underscore Europe's readiness to pool our resources, assume new responsibilities, and acquire new features in yet another unprecedented way. All the focus of the EU's institutions and processes, and at times what can appear to be to an attentive observer as cumbersome consensus building, can sometimes obscure what cannot be denied, that Europe evolves. And our response to the crisis, even if sometimes takes longer than people expect, takes leaders well into the night, provides newspapers with very good stories of dialogues and trilogues and confrontations in Brussels corridors. Even with all of that, our response to the crisis is evidence that Europe is capable of reacting, capable of evolving, capable of changing as problems arise. But we should be, and indeed we are even sometimes too much, modest about our achievements. We have learned our lessons, and I want to list a few of these before I finish. We not only contained the crisis with a determined response and impressive tools, but we are now hard at work in addressing and preventing the reoccurrence of such challenges to the euro stability. There is now strong momentum and consensus to strengthen the economic governance component of the Economic and Monetary Union. We will make a better use of both carrots and sticks and improve both our prevention, coordination, and surveillance. We know what needs to be done, and we know there is the willingness to do it. As President Barroso told members of the European Parliament in his State of the Union address early this month, we will match monetary union with true economic union. Let me list a couple of lessons. The first lesson is that we need to strengthen the governance of the euro area. Back in May, the Commission published its own proposals designed both to reinforce the Stability and Growth Pact and extend our surveillance to macroeconomic imbalances. The task force chaired by President Van Rompuy is working on proposals that go in a similar direction to the Commission's ideas. A number of common themes are emerging, and you will hear them reflected in the debate in the coming days, weeks, and months. First, the idea of a European semester has gained widespread support and has been endorsed at the highest level. This will create an integrated surveillance cycle and allow for earlier coordination of both fiscal and structural policies. Europe will be able to give timely policy advice to individual countries when they are preparing their national budgets. Secondly, we are reflecting on how to make penalties more effective for countries that break the rules of the club. To put this in Euro jargon, we will strengthen the so-called corrective arm of the Stability and Growth Pact. There is a strong case for penalties to apply earlier than they currently do, and for some penalties to apply automatically. Thirdly, we will see a clear need to broaden our surveillance framework to look not only at countries' deficit levels, but also at the crucial issue of debt dynamics. The quality of statistical data will also be improved, and countries will strengthen their own national budgeting process. The second lesson, the first one is about the governance. The second lesson we learn is that we must have a new economic model in Europe. Several dimensions in this. We must do a better job of dealing with our own internal imbalances. Large competitiveness divergences cannot be allowed to persist as they have up to now. So we will have to tackle their root causes, which means changing the structural features of our economies. In Europe, as much as in the United States, we know we will not return to our pre-crisis economic situation and growth model. It is at once impossible and irresponsible to contemplate doing so. We must face up to our long-term realities: aging populations, climate change, global clamor for natural resources, the desirables but sometimes disruptive march of technological change. We need to address all this by realizing our full potential. This is the basis of a new Europe 2020 for the year 2020 strategy, which allows us to boldly and holistically link our short-term needs with a long-term sustainable growth vision. It is about structural reform. It builds on the Lisbon reform agenda, which spurred member states to implement reforms that enabled unemployment to come down dramatically. Yet, much work remains unfinished, and the impetus for embarking on it has never been greater. Europe 2020 sets three main priorities: smart, inclusive, and sustainable economic growth. We have set clear guidelines. There is a clear political willingness to move forward on this, and this may be the theme for further debates on structural reform in both the United States and Europe, and I look forward to a solid dialogue with the American friends on these issues. The third lesson is that there has been a precedent for good policies in our own history, and we need to be able to acknowledge that. We've seen what can be accomplished when countries graduate from being weak to strong performers. I could come back to the case of Belgium for that matter, but I could also refer to the role played by the prospect of eventual membership of the euro, which has been an important policy anchor for new member states of Central and Eastern Europe. It has helped them to commit to sound economic and financial policies to satisfy the criteria for adopting the euro. I can't think of a better example of this than Estonia, which will become the 17th member of the euro area on the 1st of January 2011. As you can see, the euro area stays attractive. The fourth and final lesson I would like to draw today is that we are in all of this together, especially Europe and the United States, the two world major economic blocs. Cooperation between the US and the EU, both in the G20 and bilaterally, is essential if the world is to enjoy a sustainable recovery from this crisis. The crisis has taught us that bad things happening in one part of the global financial system can have huge implications for other parts. I believe that the same applies to good policies. What works well in one part of the world might provide inspiration for other parts of the world. And which is even more important than that, if we join forces, we maximize our chances of success in a globalized world. This is what President Barroso had in mind when he referred last week to the huge potential of a transatlantic agenda for growth and jobs. Joining forces across the Atlantic should also be prolonged in multilateral fora like the G20, where we can really make a difference. Let me conclude this too long intervention, but I've been listening to the debate about Europe and Europe's economies and the euro for far too long without being able to participate, that I wanted to say a few things now that you give me a chance to do so. But let me conclude by thanking you for your indulgence towards an historian and a diplomat. I wanted to bring to you a politically minded vision in support of hard facts and hard data about the way the European Union has made progress in recent years and how it intends to move forward. In doing so, we are sometimes pursuing impossible objectives, as Mark Twain remarked. We sometimes prepare for the last calamity and not the next one, as he also implied. But there is no other Mark Twain quote that I would find more appropriate than the one that confirms that the rumors of Europe's death have been greatly exaggerated. Thank you.